And you mentioned trade issues, and that's been a big source of volatility here recently. And it shouldn't be any surprise to investors as Donald Trump campaigned about reworking some of the trade agreements that we've had, and the reality has come due here in 2018. And you mentioned the G20 meeting later this week. If some sign of accord can get forged there, obviously financial markets would like that. But if there is no agreement, on January 1, the 10% tariff on the $200 billion worth of goods that went into place last month will go up to 25%. So you do have the potential for escalation. Margaret, do you think that we're going to get to some sort of resolution from a trade perspective, or is it going to continue to be a headwind for companies with international exposure?
I'm not quite as optimistic as Michael that we'll have a near-term resolution in our discussions with China. I think it's bigger and broader than just what the final tariff rate is going to be. So regardless of what comes out of the next G20 meeting, I think we're in for a period of frostier relations with China. And so for us, as we think about the portfolio, we think about direct impacts and indirect impacts. So the direct impacts are obviously higher tariffs. And most of our portfolio companies are talking about trying to pass along those higher costs to consumers. Caterpillar's talking about that. Grainger is talking about that. So that just means slight inflation and slight headwind to the U.S. economy. What I think is more troublesome and more material, potentially longer term, is the indirect impact, and that really comes through in translation impacts, the impacts of a stronger dollar, and in business confidence. The more CEOs are worried about that impact of China and those frostier relations with China, and the more that is a deterrent to them spending, that's not great for the U.S. economy. So that's the thing that we're asking our portfolio companies about.
I do think that there's a natural limit to how long these trade talks will continue. If you think about Donald Trump and his re-election bid in 2020, I'm sure he's willing to accept a little bit of market volatility, maybe some economic weakness to the middle part of 2019. But as we move closer and closer to 2020, I would imagine that the risk reward or the upside downside of a trade deal actually comes a lot more in favor of having one rather than not. But if trade wars continue to escalate, it's going to hurt the earnings picture. And we've had very robust earnings here in the U.S. because of tax cuts. But with tax cuts waning, is that going to weigh on the earnings picture in 2019? What's really going to drive growth and cash flow? Margaret, I'll start with you.
Well, you're right. We've been in a period of very good earnings growth, and it's hard to imagine, broadly speaking, that margins are going that much higher. It's also hard to imagine that we're going to have buybacks at the same level that we've had in 2018 and 2019. So I'm going to take us back to CapEx because what you really need is to see revenue growth. So you need the multiplier effect of companies spending and good consumer confidence and good business confidence to keep things moving in the U.S. I do think it's relevant to remember that tax reform, part of tax reform included immediate write-offs on CapEx, and so that made it more attractive for companies to spend. And when you think about what companies are spending on, it's not just diggers and factories. It's enterprise software, it's technology. So those kinds of investments, I think, will have a multiplier effect that I'm hopeful will help us in 2019.
Yeah, and I think personally that if we can maintain revenue growth close to where we are right now, revenue growth was 8% year over year in the third quarter, which has been above trend. If we can stay at 6 or 7% revenue growth, I think you can continue to see an earnings picture that hits expectations. And in my opinion, it all really comes back to the consumer. If you look at total cash earnings from a consumer perspective, and that takes hours of work into consideration plus wage gains, it's at 5.5% year over year, which is the highest that we've seen throughout this entire recovery. You put into effect also that the consumers are going to have $60 billion extra in their pockets next year versus this year because of tax cuts. And now that oil's down 25% from highs a couple months ago, I think there's going to be some extra money floating in the consumers' pockets that they can spend and keep revenue growth above trend. But obviously we've had a pretty big drawdown here recently. And with drawdowns, it creates opportunities from a sector and an individual company level. Now, Margaret, I know that you and Peter have been talking recently about the opportunity in information technology. What are you seeing in that space?
Yeah, well, we've been more defensively positioned in tech for a little over a year or so, but now you have certain subsectors of tech that are down more than 2x the overall market. So to Scott's point before about the volatility creating opportunity, I think the volatility is creating some opportunity in tech. And I think it's also worth noting that many of the other sectors in the S&P, whether it's whether it's interest rate concerns or consumer credit being at all-time lows and us worrying that it's gonna get worse from here, or the housing cycle potentially winding down, or inflation, or emerging markets exposure. Tech conveniently doesn't have exposure to a lot of those potential headwinds, so there's a little bit less vulnerability to some of the bigger issues that we're all talking about.
And I also think there's a misconception out there that tech has been fueled on speculation like the dot-com bubble in the 2000s. In fact, if you look since the March '09 lows, 90% of information technology's returns have been driven by earnings, only 10% through PE expansion.
The returns in those businesses are very, very good.
Now, you mentioned the US dollar being a very big component of the liquidity picture. Obviously, when the dollar strengthens, liquidity tends to tighten or go away. When the dollar weakens, liquidity gets more abundant.
Right.
We've seen the dollar strengthen throughout the course of this year, which is a stark contrast to what we saw in 2017. What's your outlook from a currency perspective, and how will that impact stock returns? Margaret, I'll turn to you.
As a U.S. large cap investor, we don't spend a lot of time trying to figure out what specific currencies are going to move what way in 2019, but we do spend a lot of time trying to think about where's our risk? How much risk do we have in Brazil between companies that have all their revenues in Brazil and companies that may get a portion of their revenues from Brazil, companies that may have that second derivative impact of changes in the Brazilian economy. So we think about it in terms of that and just making sure that we have good diversification, that we don't have too much exposure to some of these markets that have good growth but also have a lot of volatility.
Margaret, any perspective from a multinational with EM exposure?
It really comes down to GDP differentials, because when I think about investing in China or investing in Brazil, some of these emerging markets, they obviously have higher risk profiles and they're obviously more volatile, but it's hard to fight with 6% GDP growth. And so even if China slows a little bit, it's still a lot better than the US. And so I think you want to be prudent in terms of managing the risk of that, but I think there is some good long-term value to investing in these volatile but faster growth through the cycle kinds of markets.
And one key component that, Michael, you had mentioned that I think is underestimated by participants right now is Chinese stimulus.
Yes,
Through both
that's
monetary
true.
and fiscal levers, believe it or not, they've done almost 40 measures of easing throughout the course of 2018. 40. It's a big number.
I feel better with them on my side.
I think we're up on time. I appreciate you all joining me in the studio here today, but I want to just leave the viewers with one key takeaway. If there's one thing that you want the viewers to think about what's likely to transpire or keep in front of their mind for 2019, what is it? And Margaret, I'll start with you.
I would say that from our view, we are in the later stages of the economic cycle, but that doesn't mean that parts of the market can't continue to march higher. So when you think about your portfolio, think about diversification and think about not having all of your eggs in one basket, because I think that will serve you well in a market that's probably going to remain choppy and remain volatile, but can march higher.